Fridays in the summer are notorious for being slow trading days as so many market participants are taking long weekends. For day traders, this can be a little depressing as there's not much price movement to leverage, but for options income traders, lazy summer Fridays can actually be gold mines. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the professional traders on our desk are well aware of this dynamic and have the expertise to employ strategies that thrive in slow-moving market conditions. In this video, we'll be covering a very simple strategy that can be employed on a lazy summer Friday that can provide you with startling one-day returns. So I'd suggest you stick around because I think you're going to find this to be a valuable strategy to add to your playbook. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on your subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so as we've discussed in videos in the past, while this has been a historically volatile time in the markets, there are certain seasonal tendencies that recur for reasons involving human behavior. And while certainly August can be on occasion a very volatile month, if there's some major economic event taking place, in many instances the market just sort of dies for a few weeks, often in the last few weeks of the summer when people are getting in their final getaways before the weather turns. Now, as we said, for day traders, that can be a real drag as day traders thrive during market volatility. However, for options income traders, these can be ideal circumstances to grab great returns from the markets. Okay, so one of the signs that we're in a market that's ripe for the strategy we'll be discussing in this video is the average true range indicator, which is a popular measure of market volatility through a formula that looks how wide of a range any asset is trading in recently. So if we take a look at the average true range of the SPX index over the last 180 days, you can see how the ATR of the index spiked in March at the height of the COVID-19 crash that hit the markets, where the market would trade in massive ranges day after day. But in the subsequent months, the market began to calm down and rally, with the result being very low daily ranges, particularly as the summer wears on. And Friday is typically an even slower day in the summer, as we've mentioned, and so that is the time that an options income trader can pull this simple trade out of his playbook. Now, this trade involves index options, and so we need to make sure that everyone's watching is familiar with how index options work. If you're familiar with them, just hang in there while we do a quick review, because we'll immediately jump into the strategy right after this. Okay, so now almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires. And a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equities, except that there is no such thing as 100 shares of an index like the S&P 500. You can't really buy or sell 100 shares of an index, but what you can do is to get paid in cash, $100 per point if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So for example, if the SPX index is trading at 3350 and you buy the 3360 call, if the index closes at 3365, you'd receive $500 in cash in your account. If the index closes at 3360 or lower, on the other hand, your call would expire worthless. On the other side of the market, if you buy a 3335 put and the market sells off to 3325, you'd make $1,000. But if the market just sold off to 3335 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will allow you to sell options as well, and your broker will also allow you to put together combinations of options. In other words, option strategies that involve both short and long options purchased in a way that's advantageous to you as a trader. Okay, now with that said, the market makes available options chains related to the SPX index each week that expire each Monday, Wednesday, and Friday at 4 p.m. Eastern Time, which is very convenient for us because we can then place a one-day trade to take advantage of these lazy, slow Fridays in the summer. A very good example of this was August 14th. So let's say that on that day, we let the market settle down for about a half hour after the opening bell, at which point we were to execute this trade. So what we've done here is known to options income traders as an iron butterfly. With an iron butterfly, we sell a call and a put at the same strike price, as you can see, by our having sold the 33.70 call and the 33.70 put. That was intentionally placed almost exactly at the price that the market was trading that day, which was 33.72. Then for protection, we went up 30 points and bought the 3400 call and went down 30 points and bought the 33.40 put. So this formation, again, is what we call an at-the-money iron butterfly. And this trade is intentionally traded using the options that expire that day, in this case Friday, to take advantage of the typical slow nature of the market on these kinds of days that we've been discussing. Before we get into exactly how this trade works, I wanted to let you know that there are lots of other sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors of the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an options strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now let's go ahead and break down what has happened to our account once we enter into this trade. So we received $9.15 for selling the 33.70 call, but remember that represents $100 per point should the market close above 33.70. So you need to multiply that by 100 for a total cash inflow of $915 for that call. The same goes for the short put that we received $675 for. The long protective call cost us $45, as you can see from the calculation, and the long put cost $125. So when you net it all out, we receive $1,430 of net cash flow when we start the trade. Now, your broker is going to require capital of $1,570 for this trade, which is the largest possible loss if the trade goes wrong. Okay, so now remember, this trade is predicated on the thesis that the market will be sluggish on a lazy Friday in the summer. And of course, if that isn't the case, then our thesis was wrong and we'd need to exit. But the beautiful part of this trade is that if we're right, then while the day traders were struggling to find some price movement on anything to trade, we would be in a position for a large one-day return potential. So let's move now to the end of the day. And remember, the options expire today, and so they'll be settled today. And cash will be dispersed for options that are in the money and have value. And otherwise, the options which have no value will simply expire and basically die. So what's happened in this case is that the SPX closed at 33.72, which was almost exactly the price that we entered the trade, which of course is a bit of a fluke, and certainly very few trades will work out this perfectly, but it does happen now and then, and so you shouldn't discount the possibility, especially if you've observed the markets and sense a sluggish Friday in the middle of the summer. Now let's analyze how this trade will be settled, because that's the key to understanding the profit situation. So remember now, we started out with a credit of $1,430, and what a lot of people forget is that no matter what happens on the trade, that original cash that came into your account from entering into that trade, that is yours. You get to keep that cash. Whether later you have to give some of that cash to pay for obligations under your short puts or your short calls, well, that's another matter. But once you receive that cash, Until further notice, that's yours. So when calculating your profits on a trade that starts out with a credit like this one, you need to start with the initial cash you received. So you'll see the calculation starts with that $1,430 in cash. Now, moving to the protective call at $3,400, well, that expired, worthless, because the market closed well below that price, and so there's no settlement value for that option. Now, that $3,370 call, well, that has value. Unfortunately, that value is to the guy we sold the call to, and remember, the SPX closed at $37.7290, so that is $2.90 above the $33.70 call strike price, and so multiplying that by $100, your broker will pay on your behalf $290 to the owner of that call. Now, moving down to the put side, you'll see that both the $33.70 and the $33.40 puts have both expired, worthless, because both of those expired below the closing price of $33.72, and so therefore those have no value. So when you net it all down, after paying off the $33.70 call owner, you end up with $1,140 in cash as your profit. Now, that's an incredible haul for one day when your capital requirement was $1,570, and in fact, that's a 72% return. Now, as I said before, this kind of luck is not going to happen every time, but on a slow-moving market day, your chances of something similar to this happening are fairly good. So keep this trade in your playbook, and you might be able to use it on one of those lazy, slow days in the summer when your day and swing tradings might not be working for you while your options income trades are flourishing. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. So go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.